The NASDAQ has put up incredible numbers in this first half of the year. We are talking about more than plus 30% in only 6 months. Numbers that are even more extraordinary when compared with that of the other major American index, namely the S&P 500, which to date is stuck at only a plus 12% since the beginning of the year. How then is such a different performance between these indices possible? We will see in this video. Spoiler. It has to do with their composition and division by sector. NASDAQ Composite and S&P 500 are very different indices. The former was created in 1971 and contains within it over 2,500 companies purely in the technology sector. Companies that are classified as growth, that is, growth-oriented companies. The S&P 500, on the other hand, is an index compiled by Standard & Poor's that contains within it the top 500 American companies. Be careful, however. These 500 companies do not have to be the largest American companies. In fact, the index is compiled by a committee of analysts who, in addition to capitalization, take into consideration other factors such as financial stability, liquidity of the shares on the market, and country of origin of the company. In the S&P 500, in fact, we will only find companies that have generated at least 50% revenue from American soil. So these are companies that are more solid, stable, and tend to be more conservative than the companies we find in the NASDAQ. In fact, it is no coincidence that apart from a small interlude in the 1970s, the NASDAQ has always outperformed the S&P 500. In some cases, such as during the period of the dot-com bubble, the companies in the internet sector, it even overperformed by a factor of 3. Obviously, the two indices share a good number of companies, and it is precisely some of these that have been behind the recent rises. Let's talk, for example, about NVIDIA, the company now world famous for its semiconductors and microchips, which in the last 6 months alone has posted a performance of plus 170%. But we also talk about Meta, AMD, Tesla. These are all present precisely in both indexes, but it is at the lower end of these indexes that we find the biggest differences. Here we can see that apart from a few exceptions, such as, for example, the Chinese company JD, the solar panel company Enphase Energy, and Moderna, the selling on NASDAQ stocks has been rather restrained in the last 6 months. In contrast, however, in the S&P 500, the companies that have underperformed by at least 25% are many. As we can see, the index has suffered greatly from the crisis in the financial sector and has absorbed the losses of US regional banks. The strength of the NASDAQ then lies precisely in this. Being a highly sectoralized index, it exaggerates both the positive and negative performance of the sector that clearly most characterizes it. S&P 500 and NASDAQ, however, are not the only alternatives for investing in US markets. In addition to the technology sector or the financial sector, there are also 9 other sectors into which companies available in the market can be divided. For example, one of the sectors hardest hit last year by sales that has recently reversed exactly like the technology sector is the telecommunications sector. In this sector, Michael Burry started investing right at the beginning of 2002. Really very close to the low point of this sector. By the way, just on Michael Burry's latest moves, we recently made a video. If you missed it, I'll leave it in description so you can catch up. However, we are not only talking about uptrends. In fact, these sectors are also good to understand which sector to stay away from or on which to make short trades if we can identify bearish trends. The most resounding case is that of the energy sector, which in the first 6 months of 2003 was the worst sector of all 11, recording minus 10% after. However, in 2002, it posted a rise of plus 300%. This sector clearly is very much influenced by energy commodity prices, which, as we know, after reaching record lows in the pandemic period, with the price of oil even going negative for a few minutes in May 2020, have accelerated upward very strongly because of the energy crisis that broke out in turn because of the war between Russia and Ukraine, with oil prices between $70 and $80 a barrel and natural gas prices returning to pre-pandemic levels. A lull has probably arrived for this sector. Another sector has also suffered losses of 5% since the beginning of the year. I'm talking about utilities, a sector that is also correlated with the price of energy commodities. And as far as the other sectors are concerned, the rather unique feature of 2003 is that the other sectors more or less all broke even. Therefore, it will be very important in the months ahead to keep an eye on them to see whether the technology sector will still remain the protagonist in the second half of 2003 or whether there will be a reversal. In that case, other sectors could take the lead in the market either positively or negatively, and we investors could exploit the movements of these sectors to take profits. The ETFs on all 11 sectors of the US economy can be found on Kimura Trading's platform. I leave you in the description the link to open a real account or to try a free demo account.